Hello there. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during this event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Alec Bethurum is the Senior Portfolio Manager and Senior Financial Advisor at Sternick Capital. Before joining, Alec worked for several bulge bracket Wall Street firms. His work focused on institutional equity research, sales, and trading. Alec then worked as a proprietary trader for a West Coast-based hedge fund. Over the years, Alec's contribution to client success has evolved from focusing purely on securities research and asset allocation to a more holistic advisory role, including involvement in behavioral finance, tax, and financial planning. Sternick Capital has been offering clients investment management and financial planning insights for more than a quarter century. Founded in 1989 as a New York City-based hedge fund, the practice moved to Kansas City in 1999 and transitioned to offering individuals and families access to institutional-level financial planning and asset management. Today, Sternick Capital is proud to be a fee-only firm with a fiduciary responsibility to put its clients and their needs first. And speaking of behavioral finance, that's what we're going to talk about today. And we've had a lot of fun preparing for this one, Alec, I know. So I'm excited to hear what you have to say. And I want to tell, again, people who have questions or comments, go ahead and put those in the chat. We'd be happy to hear from you.
Thank you, Marcia, for that introduction. And it's a pleasure to be here today. And, as she said, we're maybe going to talk about a topic that maybe isn't as in the mainstream as some other topics are, but, really it's the subject of behavioral finance. And, we think really it's probably, just as important a topic to address as some of the more traditional topics like asset allocation or financial planning or trading. And, the reason for that is we could have the best financial plan, we could have the best asset allocation strategy, we could have the most sophisticated trading platform. But if we can't keep our nerve and weather the storms when they inevitably come along and we make emotionally based decisions, it's not going to matter what any of those things are. We're going to have a result that we're not going to ultimately be happy with. So that's kind of the topic today. We're going to talk about what some of those biases are and how we can address them. And one of kind of our favorite quotes on that topic comes from Benjamin Graham, who was really the mentor to Warren Buffett. And, you might have seen this over the course of time. And, it's as relevant today as it was when he initially, made this comment back in the 1930s, 1940s. And, the quote is, "The investor's chief problem and even his worst enemy is likely to be himself." And so, we're just going to kind of go through, look at what the agenda today is and, how to address some of that stuff. So, the first thing we're going to talk about is, what is it in human nature that hinders our investment performance? And, why are we not necessarily the best decision makers in periods of duress? We're also going to then talk about, what are some different strategies that we can employ that might be out of the mainstream that are going to allow us to counteract some of those natural tendencies and hopefully, get to our ultimate goals. And finally, we're going to talk about, what an advisor could potentially do to help you to avoid some of those innate biases. And once again, ultimately get to what our goal is, which is for you to reach, your financial outcome that's going to serve you the best. So as we kind of look here, the real innovators on this topic are two gentlemen, two academics out of UC Berkeley. One was Daniel Kahneman, and he had a partner named Amos Tversky. And really what they did was a number of studies back in the 60s, 70s, and 80s that indicated, how humans made decisions. And what they really came up with was there are sort of two different systems going on in the human brain. And system one is the more traditional methodology that we're familiar with, kind of, the fast, the automatic, the emotional, the stereotypical, and the subconscious. And you can just think of this as kind of your natural reaction to a situation. What do you do when you don't think about it? And, while that is certainly, oftentimes might serve you well, we get into investing, it's not necessarily the best way to address the situation. And, the next slide, we kind of just think about, why do humans behave this way? And it's sort of interesting if you think about it, even though we're obviously much different than, our caveman ancestors, when you get down to a genetic level, we're really not all that different. And so if you think about, two cavemen out there in the woods or out in the jungle hunting, and, you hear a noise, who is most likely to survive? Is it the one that turns and runs as fast as they can? Or is it the one that, steps out of the trees and decides to go, check around the corner and see what that noise is? And, if you think about it, it's obviously the one that, made the instinctual decision to go on the run and survive. So that's the genetics, unfortunately, that have been handed down to us, over the years and kind of, are still driving our decision-making today. So that's
Okay.
type one. Sorry, go ahead.
Yeah. So just to clarify, so what you're saying is that this would be like an immediate reaction to immediate perceived threats. Is that what you're saying?
Correct. Almost like, the fight or flight kind of, decision making. And, if you go back again, who was more likely to survive, at that point? Was it the person that decided to stay and fight the saber-toothed tiger, or was it the person that decided to run and fight another day? And so, and that's even, believe it or not, that's kind of scientifically, they've gone back and kind of look at, different genes and those kinds of things. And, that's kind of the innate tendency that we have. And it makes sense, if you think about, we're just a way down the line kind of version of that initial genetic makeup. So that's the kind of type one that Kahneman addressed. The type two is really the type of decision making that we want to be more conscious about making. However, our brain is constantly fighting, telling us that's not the way we want to make a decision. So type two.
Oh, sorry, you broke up there really quick. So telling us we don't want to make that decision. Can you say that again?
Your brain is telling you to run. That was great in a period when you're out in the jungle, but now today in the current environment, running isn't necessarily the best decision right away. And we can just immediately think about that from an investment perspective, right? The market goes down. History has told us over and over that selling into a down market immediately or having that emotional reaction isn't going to give you the best long-term result. And we'll look at some more details of that kind of further on in the presentation. But, this kind of secondary or type two thinking is really what we want to try to be conscious of so that we can, go ahead and use these kind of tools to make decisions rather than that instinctive type one or system one type of decision making. And so, we're going to talk about some of that. And then I just always kind of think about this as our picture. This is our friend, the caveman, way back when, our distant relative that wasn't alive to pass on his genes to today. He's the guy that came out from behind the tree and didn't run, or the guy that went to check inside the cave to see what that noise is.
Hey, just one more comment here. Alec, you might want to just turn off your video. Your audio is a little choppy and that'll cut down on the bandwidth. So you can just turn off the stop video and that'll fix it. Yep.
Gotcha. So this just quantifies now, how that kind of behavioral performance has a negative long-term impact on investor results. And this is a group called Dalbar that does a lot of different investor behavior studies. And, what they found was, and they've actually repeated this study again to kind of update it to today, and the results were pretty much identical. But from 1985 to 2013, the underperformance that was directly attributable to investor behavior was about 3.5% per year. Now, somebody might say, well, that doesn't sound like that much. Why is that big of a deal? But you look down at the chart at the bottom, and that's a 30-year history of what that spread on an annual basis results in when compounded. And in year one, they started with $100,000. By year 30, you can see that, the difference in that 3.5% of behavioral impact results in, about a $1.2 million difference. So certainly a significant difference over the course of a long period of investing. And, really the reason why we want to try to address these issues and, be cognizant of them, because by being cognizant of them, hopefully we can counteract them and make better decisions. So, the next thing we're going to do now is, like, as I just said, the first step to counteracting some of this stuff is to be cognizant of it. And, the interesting thing is that most of these underlying behaviors are really, not out in the open. They're not overt, they're subconscious. So, we really need to kind of identify them in order to counteract them. And so now we're going to kind of talk through, what are a few of the biases. And so this first one is loss aversion. And there have been a number of studies on this topic that essentially what it means is, when somebody takes a $500 loss, let's say, they feel that emotion twice as much as they would a $1,000 gain. And, once again, it really goes back to that kind of, our genetic history. If you were out in the wild and you had one piece of meat to eat and you got a second piece of meat, the second piece of meat didn't feel all that great. But if you had no meat to eat, you certainly felt the ramifications of that. And so, we always kind of like to use this less scientific study, but, anybody out there with kids, can certainly kind of appreciate this. I certainly know at our house, we've seen these kind of situations, give your kid one toy, lovely reaction, give them two toys, they're happy, but probably not that bigger, not that much bigger reaction the first one. Then you look at no toys. And, I think all of us are kind of familiar with that face when you see it. So, that's just something to be cognizant of in general, that, we're going to react more negatively to losses. When we have losses, it's a time to step back, reconsider the situation, not make an emotional response. The next one is kind of interesting. And this is one that's, relevant both in the short and long term. We kind of use this terminology, keeping up with the Joneses, which is, kind of a standard stereotype out there. But what we really mean by this is, a lot of times, many of us as investors have been in a situation where, we're at a work party or a Christmas party or a cocktail party, and, there's somebody over in the corner telling us, how great they're doing in a fund, how much money they're making. And, our first reaction is to kind of go home and see what that fund is. And, without really doing a lot of investigation or thinking about it, a lot of us want to run out and buy that investment. And, what we've usually found is by the time the specific investment, has made the cocktail party rounds, it's probably not as attractive as it was, when it was initially maybe purchased. And, the other thing is, the person you meet at the cocktail party never tells you when they sold the investment or anything like that. So you're kind of out on your own. And we're just going to look at a couple of things here that kind of quantify, that story and kind of, put it in perspective. So this is kind of interesting. Any of you are familiar out there, Morningstar does mutual fund ratings on an annual basis. And a fund will either be a 5-star fund would be the highest rated, a 1-star fund would be the lowest rated. And, if you're kind of thinking about that, you would assume that when you buy a 5-star fund, you should actually have superior performance over the subsequent period of years than, say, a 1-star fund. And what they actually found when they went out and looked at this and did a study of it was that in reality, the reverse was the case, that you can see all the way out on the right there. So this is the subsequent 3-year combined performance of a group of mutual funds, either rated 5-star, 4-star, 3-star, 2-star, 1-star. So you see the 5-star, which was the best rated at the beginning, its subsequent 3-year return was about 39%. So that should be the best performing. Conversely, the 1-star, which is the one that should be the worst performing in the subsequent period, that actually outperformed by about 7%. So, what's the reason for that? Well, it's that same kind of, chasing returns, which is that people are throwing money in at the top. Everyone's talking about it. That's already when the things that the fund owns are expensive. That's when the expectations are the highest. And so, you tend to get periods of underperformance. Now, it might normalize again over time, but it just shows you that, going out and rushing out and buying what was the best performing asset in a previous period is usually the path to having a less substantial result in subsequent periods. And then this next one is a little bit more recent and closer to home. Some of you out there might own this fund. This was Kathy Wood and the ARC Innovation Fund. And it had a spectacular period of returns. You can see there kind of from February around the end of COVID period kind of thing up until say December of 2020. So that's what that purple line represents. That purple line represents the value of the fund. The green lines represent the fund flow. So that's money coming into the fund. And you can see there that the two largest green bars came right before the fund topped and then went significantly lower. And actually, if this was carried out further to the right, you can see it ends in January or February of 22 there. Out into 23, that price has come all the way down now into the $30 or $40 range. So, it's just interesting to see that same phenomenon that we saw with the 5-star funds playing out here in an ETF that was, in the press pretty often in the 2020 time period. So the next one that we always like to talk about is media response. And this is sort of, this idea that because somebody's on television, they must be an expert in the topic that they're speaking on. And this really isn't to denigrate anybody that's speaking on television. It's really to say that, the goal of somebody speaking on television is not necessarily to have you have the best investment results. The goal of that person is to get you to watch the television. And so if you think about this, they're not putting anyone on TV that's going to have a mainstream opinion that's going to say, oh, the best thing to do is just sit there and do nothing, hold your stocks long-term, avoid the noise, right? The people that are going to get the time on the TV and the press is someone who's going to have an outlandish opinion one way or the other. And usually that's either going to be, XYZ stock is going to change the world in the next 18 months and be worth 100 times what it is today. Or, XYZ stock is a zero. Don't believe what you see in the world. Don't believe that Amazon's selling a ton of products. They really have no earnings and the stock's worth $50 or whatever it might be. So, I spent a big portion of my life working on a big trading floor on Wall Street where we had, 50 of these TVs on all day long on CNBC. And it was interesting once I got into a smaller firm and kind of could turn the TV off, how kind of avoiding that noise is really ends up being highly beneficial over the course of time and keeps your emotions from getting too high or too low on any topic. The next thing is what we like to call picking the roses and watering the weeds. And what that really means is, let's say we have a portfolio of stocks and we have, a couple of stocks that go up and a number of stocks that go down. What we tend to do, and it makes sense if you think about it, is we tend to want to buy more of the stuff that's going down, and then the stocks that are going up, we want to sell those. And this goes back to that loss aversion that we talked about. If we see something going down and we buy more, we feel like we've adjusted our cost basis. We're avoiding the loss. And then the other side of it is any gain feels really good, so we're going to take that gain. And in reality, the opposite of the situation is the truth. And we always kind of use the analogy of baseball here. And, Ted Williams, one of the most famous hitters of all time for the Boston Red Sox, used to say that, baseball is the only activity or sport where you can get into the Hall of Fame, be one of the best ever, only being right 1 out of 3 times. So, a 300 batting average, turns you into an all-star, making hundreds of millions of dollars. There's very few other endeavors that's the case. Well, truthfully, stock investing, that's the case to some degree. And Warren Buffett even actually addressed it in his letter, his annual letter that just came out a couple of weeks ago, talking about the fact that there's really only been, 12 or 15 securities that Berkshire Hathaway has ever owned that have really driven all of the returns. And, nobody really kind of thinks about that. So we just have a quick mathematical example just to how to think about that on the next slide. Here we have 10 stocks that we bought. We have $100,000 that we put in. We have 10 stocks that we bought. And this goes back to that Ted Williams analogy. 8 of those stocks could be down 10%. We have one that goes up 100%, one that goes up 200%. And our total return is, about a 22% return. So the key there is to let the stuff that's working continue to work. And, we actually want to cull the herd. We want to actually pick the weeds and go ahead and reallocate that capital to stuff that's working. And, that's how you're ultimately going to generate the best returns. And there's another quick kind of analogy on that topic, a quick story we always kind of tell on that topic, which is, nobody ever makes money in a stock or an investment by buying or selling it. All the money is made in waiting, right? There's no money actually made when you buy it. There's no money. I mean, you could argue that if you're selling, but nobody really made selling it, but that's the most difficult thing from a human psyche perspective, is to be able to sit there and wait through the volatility, wait through all the movements. If you go back and look at stocks like Amazon or Microsoft, to get to where we are today with 1,000% returns over a decade, there have been multiple periods where the stocks have pulled back 15, 20, 30%. You have to be able to weather those storms and take a long-term outlook in order to eventually, get to those long-term returns. And so this was all kind of fun too. So this is anchoring, and this is kind of our tendency to look at a number that happened before and then make all of our subsequent decisions predicated on that number. And so, an example in the stock market world might be, Tesla as a stock was a $700 or $800 stock. And, let's just make the argument that it was extremely overvalued at $700 or $800. And then we'll see it come down to $600. And we'll say, oh, well, it was $800 before, so now that $600 must be really cheap. Or it's the same thing with earnings. We had a lot of companies say that did really, really well during COVID. We're on a Zoom call today. That's a perfect example of it. That was obviously an extraordinary period where those earnings materialized. Unless we think there's going to be, multiple other, COVIDs coming up over the next few years, kind of thing, that are going to drive those same kind of behaviors. It's unlikely that those earnings are what we should rely on when we value the company in the future. And so, we just have kind of an example here of something that is a little bit tricky and almost something to keep in the back of your mind. On the next slide. So I don't know if anyone is familiar with serendipity. Serendipity is kind of a famous food and ice cream store near FAO Schwartz in New York City. And, one of the gimmicks that they had for a while was they had a hot dog that was $70. And so it had all kinds of, different cheeses and et cetera that was supposed to kind of, but really they sold almost no $70 hot dogs. The whole point of advertising that and putting it on the menu was then they had a $26 hamburger or a $32, BLT sandwich. Everyone said, well, that looks great after having the $70 hot dog. They never realized that down the street there was a $5 hamburger and a $6 BLT kind of thing. So it just kind of shows you how, the human mind tends to do that. It'll see a price, use that as an anchor, and then make, less than rational decisions based on that initial figure. So those are kind of some of the biases that exist. And now we're going to try to talk about, ways that we can counteract those biases. And Howard Marks here is kind of one of my favorite, other investors that's out there. And he runs a firm called Oak Tree Capital, which is a high yield investment firm out in Los Angeles. And, he says that to get superior performance, you have to be unconventional in some way. And that's the only way to really, eventually get to those long-term results that we're looking for. And, he kind of uses the terminology of level 2 thinking, which is, let's think about the consequences beyond what we're just making a decision on today. And that's kind of one of the big things that he pushes. And that's what we always say is, there's immediate consequences, but let's think about what the long-term consequences are. Let's say I'm going to eat a piece of chocolate cake every day. That feels great on that individual day, but the second level consequence is I'm going to be unhealthy, I'm going to be overweight, whatever it might be. So we're just going to kind of talk about a couple of things. This is always a story that I really kind of appreciate that kind of gives you just an example of, what that second level thinking is. So during World War II, there was a group of statisticians, PhDs, were assigned to the Air Force. And there was basically a group of long-range bombers. And, in a long-range bomber, they have to make a calculation as far as, how much weight to have on there. So whether that's fuel, whether that's armor, et cetera. And they're constantly trying to balance those different variables to get a plane that could fly the furthest, but also be the most maneuverable. And one of the ways that they initially came up with doing that was when the planes would come back from a bombing run, they would look and see where the various bullet holes were in the plane. And so the idea originally was, well, we want to over armor, those areas where the bullet holes are. Intuitively, that makes sense. Well, Abraham Wald came up and said, actually, that's the opposite of what you want to do, because these are the planes that have been hit. They've come back. What we're worried about is where are the planes that didn't come back? Where were they hit? And so it turned out that was really the engines were the areas that got hit. Also intuitively makes sense. And they took a lot of weight of the armor out of the tail, out of the wings, put it into the engines. They ended up with lighter planes. They're able to fly further, and the recovery rate, skyrocketed on these certain long-range bombing missions. So it just kind of shows you that, what you see immediately or intuitively, it's not always the right answer. You want to try to get to that second level of thinking. What's that second level of thinking? That's the type 2 thinking, right? The type 1 thinking was, oh gosh, there's a bunch of bullets here. Let's block those. Well, that makes sense, except for, what are all the planes that aren't here, kind of thing. So that's just kind of an example I was like on that topic. And so this just goes back to, us trying to be long-term. We use this chart for all kinds of different things, but really what this just shows is, what humans tend to do is we tend to extrapolate kind of near-term results into the future and put a higher probability on whatever is going on right now than, is actually the case. And so this just shows you all those red lines there are different drawdowns in the stock market since 1930, through 2021. And, every time we get into one of those drawdowns, goes back to what we were talking about earlier about the press, they act like the world's coming to an end, imminently, kind of thing. Well, if you take a longer term perspective, those drawdowns have actually been pretty common over the course of time, every 3 or 4 years, at the least, sometimes, even more common. So, just kind of it's good to step back, take perspective, realize that what's going on now, is very likely to be similar to something that's happened in the future or in the past, excuse me. And that's the old, kind of Mark Twain, history may not repeat, but it does rhyme. And that's kind of the way we think about these things. So that's that chart. This next one's even a better version of that, which is, this is just total stock market performance all the way back to the Great Depression, 1928. And, when you kind of look at this chart, you start to think, what are all the things that have happened over the course of this period of time? We could talk about World War II. We can talk about the Cold War. We can talk about Vietnam. We can talk about, Watergate, the Kennedy assassination, Black Monday, the dot-com crash, the Great Recession. So, all these different things have happened over this period of time. Each one of them that seemed in that period to be, some significant change that was going to, greatly diminish returns going forward. And the fact of the matter is, even when all those events are going on, people are going to work every day. Businessmen are trying to make their business more efficient. Innovators are developing new products, all those kinds of things. So humans have shown a fantastic capacity over the course of time to innovate and have solutions and solve problems and all those kinds of things. So, this just kind of, by stepping back and taking perspective, this goes back to that Kahneman, let's think slow, let's be deliberate, let's be thoughtful, let's be second level thinkers. And that allows us to avoid those emotional decisions in the short term. And so this is another one that we like about. This is about being systematic. And I know this isn't always the best kind of chart to read, but the point of this is a periodic table of investments. And what that really means is, for any of you, science majors out there familiar with kind of the traditional periodic table, this is really in every given year what these different asset classes did from a performance perspective. And, what we just like to look at here from a very simplistic level is, just like the 5-star funds, the ones that were in the 5-star tended not to do as well in subsequent periods. The ones that were 1-star tended to do better in subsequent periods. This is the same here. If you went kind of did an analysis of these colors, particularly like emerging markets, which is this orange color here, like the top one in 2003, you'll see that there's a grouping together there of those being together for 5 or 6 years. And then as you come down to the bottom, for the next subsequent 3 or 4 years, they'll kind of could be lower kind of thing. And so, the point of this is part of driving some, significant or superior returns over time is saying to yourself, okay, I know that even though these markets are good markets, they're going to be cyclical in nature. Most things are cyclical in nature. Let's try to use periods of strength. Let's say we started at 50-50, and now because it went up, it's now 60% of the portfolio. Let's reduce that down, knowing that a period of outperformance is likely to be followed by a period of underperformance. And so that goes back to that second part of Kahneman, not letting events dictate your behavior, having a systematic plan in advance, and then going ahead and executing to that plan, regardless of, what noise you might hear on CNBC, what your neighbor might be buying, all those different things that might, try to, impact your decision-making process. So this is kind of one of my, it's so simple, why isn't everybody doing it? And I was kind of like, a lot of Warren Buffett in this presentation, but he has a lot of good quotes. But he says, seems to be some perverse human characteristic that likes to make easy things difficult. And I always kind of use weight loss as an example here. We kind of could think, scientifically, if you eat less calories than you burn during the day, whether that's because you eat less or do exercise more, you're gonna lose weight. Now you could argue that it might not be the healthiest way to lose weight, but you're definitely going to lose weight kind of thing by executing that. Yet, nobody ever has that as their primary diet plan. You've got things like the Atkins diet, where we're only going to eat bacon instead of everything else. Or you've got, whatever these different diets that are out there, nobody ever says, simply, eat less calories, exercise more. And so it's kind of the same thing in investing, which is that, the simple answer is you really just want to be deliberate about your decision making. You want to take advantage of drawdowns to buy, additional risk assets. You want to be systematic, all those kinds of things. Yet, that doesn't really resonate as well either on Wall Street or with investors. So what are some of the reasons for that, right? So, we hear stories about this all the time, short-term performance. It's amazing how many clients we have that say, I'm long-term, I'm long-term, I'm long-term. And then, within the first quarter, you're down 1% less than the market. They want to know what the problem is. So that's exacerbated. It's actually less of an issue. We actually have pretty good clients and investors, less of an issue for us as it is for a lot of institutions where, that becomes a problem. And that goes to job security risk. So if the guy out there, it's not his money, he's managing it for a large pension or something like that, there's not a whole lot of incentive for him to do something different than the mainstream, because if he fails in the mainstream, it's kind of the old, as it says in the next bullet point, better to drown together than drown alone. He can just say, hey, it's what everybody else is doing. It's not my fault. The other ones we kind of talk about, they kind of go together, but, Wall Street doesn't benefit from simplicity. And, Marche and I were kind of talking earlier about, all these different terminologies that are out there. The vocabulary of investing is almost, a dictionary in its own right. And, some of the impetus behind that is, it becomes easier to sell things to clients or give them the impression that they don't understand something that's relatively simple by employing, a super sophisticated vocabulary that maybe could be explained, in a much easier way. And then, the last one is kind of the same as the diet. You can't sell, get skinny slow. The same thing. It's very hard to sell get rich slowly. Nobody's running out there saying, hey, I got a great idea for you. You're going to make a whole lot of money in 30 years. Everybody wants to hear I'm going to make a whole lot of money tomorrow or next quarter or whatever it might be. So, there are a lot of inherent industrial drivers of Wall Street that kind of, maybe hinder people from doing some of these simple things that really could drive better results over the course of time. So this now is, how potentially can we help as an advisor? And one of them is experience. And there's an anecdote we always talk about here, I think is kind of interesting. They did a study of a number of professional tennis players versus, say, second-tier tennis players. And what they did was they would basically take a camera shot or whatever of what the person who was receiving a 100-mile-an-hour serve would see when that serve was coming. And then they would ask the person what they saw. And the highest level professional tennis player could have, granular detail that they could point to. They could say, oh, the lady in the third row was wearing a red hat or whatever it might be. And the reason for that was because they'd seen that serve so many times that their brain literally would slow down and take a snapshot. So that's why they're able to return versus the second level tennis player that wasn't able to do that. And so it's really the same thing, obviously on a different level, but for the financial advisor. So we've seen all these markets before. When we had that chart that was up earlier with those, various drawdowns over 100 years, fortunately, I haven't been here for 100 years, but for the most part, we've been through these experiences before, and it makes it much easier for us to have confidence in, the ability of the market to come back. And we kind of know, what these situations are going to be. So that's just one example. The other one I always kind of say is, separation from money. It's kind of like, it allows us to kind of reduce the chance of an emotional decision. I just kind of go back to my kids. If you want to take away a toy from we want to take a toy away from my daughter, my son's all on board. As soon as we want to take a toy away from him, he's certainly not as happy about it. And so just kind of separating yourself from the situation means that you're not going to have it as an emotional decision initially. And then the last thing is it's much easier for us. This is our profession, to be data driven, to be research focused, to step away from some of the noise and really, back to our original conversation, utilize more of that type 2 thinking than that type 1 thinking, just because this is what we do for a profession, and we're certainly familiar with those innate biases more than some individual might be. And so this is kind of a summary of the situation. Basically the human brain is unfortunately, passed down from our caveman ancestors, hardwired to not necessarily make the best investment decisions. Those initial kind of reactions that we have to things, don't always serve us as well. That just goes back to those same qualities that our ancestors passed down, are going to drive us to, use more of that type 1 thinking than that type 2 thinking. And really, we want to try to utilize that type 2 as much as possible to have the best long-term results. And then finally, just, we certainly think, we might be slightly biased ourselves as financial advisors, but, we certainly think that having a financial advisor adds significant value in, making you aware of your biases and hopefully helping you to make, better decisions, even outside of just, the traditional areas of financial planning or tax planning that we're involved in, really helping you with that emotional side, really, we think adds just as much value over a long period of time.
All right. Well, we're going to go ahead and open up the floor to questions. And I have some questions here to start off with. How often does it make sense to look at returns if you're talking about maybe people who are panicking when they see the market's down? I know last year was hard. How often should you keep an eye on the market?
I mean, believe it or not, the best answer is as little as possible. And I go back, and I know that doesn't, but it goes back to that Dalbar that I mentioned that's done all these different studies over the course of time. And they've done a study on exactly that topic. They actually went and looked at over multiple years. They had a sample size of people that they showed statements every month, every 6 months, every year. And the people that they showed the investments to every year substantially outperformed the ones that were showing statements on a less frequent time period. And it just makes sense, right? Because, the less opportunity we give ourselves to make a mistake, the less likely we are to make a mistake. And so, that's it, and that's not to say that you should be blind to a situation or something like that or anything like that. But, we see it all the time. And we've actually had, clients that we find have the best success that'll say to us, in a period of volatility, I just look at my statement less, kind of thing. And then that sounds very simple, but that study has indicated that that's really an effective means of doing it.
All right, just had to find my mute button to unmute myself. As far as looking at returns and maybe like when you're in a transition period, as you near retirement, does it make more sense to be more aware of how your portfolio is doing? Can you talk about that?
Yeah, I mean, so we can talk about that a little bit. That period around retirement is actually the most important as far as, either being very cognizant yourself of what you own or getting advice from an advisor. And that's really because what you don't want to have happen is, let's not forget, when you retire, you're essentially turning those savings now into a means of income in the future. And so you're withdrawing assets. And so even though it's very easy for me to show that chart of, the fact that the market's come down, eventually recovered, it doesn't kind of take into account that if you get into that period where the market's drawing down and you're being forced to take out money at that time, that can be a very detrimental situation to your long-term returns. And so we would always, that's a really important time to talk to an advisor. We would really counteract that issue with asset allocation and some alternative investments and other things that we utilize to mitigate risk or lower risk into that period. Interestingly, the flip side of that is it's kind of like, I saw a story the other day about there's a lady who's the oldest, I think she's 120 years old. And they said she took up smoking at 115 just because. Well, it's kind of like that in investing, because when you get to 90 and you don't need those assets, you can actually be extremely, very risky with your investments. You can take more risk at that point because you're not as concerned with those assets, having that volatility or being forced to withdraw into a downturn. So it really is that period around retirement that it's most important to really be cognizant of that stuff and get it right.
All right. So we had a question back on this slide, and I want to pop it back up here. Can you explain why investor behavior led to a 3.56% per year difference? Explain that a little better.
Yeah, so it goes. So this is obviously just a study that was done, but what it really goes back to is the implementation of those biases, right? So let's think about it this way. Let's think about that this period was 1960 to 1990, and we had all those things. We had the JFK assassination, we had Vietnam, we had all these different opportunities for you to sell stocks into periods of pressure. Or the interesting thing about it is it's just as hard to get back in as it is to get out. And we see this all the time with clients, right? We actually saw it over COVID, where we were really successful in keeping almost everyone who was a client of ours in the market. But there were a couple of people that, panicked out and wanted to go to cash and those kinds of things. Well, what happens then is now you end up being out of the market and the market's rising. And now it becomes extremely hard to get back in because you've anchored to that low price that you sold at. And you say, well, I only want to buy it when it's back there because that's where I sold at. Meanwhile, that could be a 20, 30-year bottom and you're never going to get to that price. So now what happens is you wait. And finally, one day, what do you do when the market's up 25 or 30? Oh, I can't stand it anymore. I've got to get back in. Well, what's that likely to be? That's likely to be the top of whatever that cycle is. And so you just kind of get yourself stuck into that situation. So it's really all of the innate biases that we talked about, which is whether that's loss aversion, whether that's anchoring, whether that's chasing returns. It's all those different things that play out in this scenario. And there's even, some studies that say, if you only miss, I forget the exact numbers, but it's something like if you only miss 10% of the days in the market and those are the up days, the performance variability is extremely wide. And so that's all that's really going on here is these are all the investor biases that we talked about playing themselves out on a broad basis over the entire market that results in that spread. And it's just like the ARK fund, right? That we just looked at in that other slide. Same thing. Everyone's much at the top, thinks they're going to own it. Now it's down. They were so happy. Now it's down a giant percentage versus the market. Now I've got big underperformance versus the S&P 500.
Interesting. I have time for one more question. This is a good one. Speaking about loss aversion, how do you combat that feeling that you're losing a lot more than what you had potentially gained, even though it's not the same?
Yeah, I mean, it really just goes back to having the confidence in what you own as a long-term investment. So it goes back to kind of what we try to talk to people all the time is separating the stock from the company. So we see this like, let's say, we've had some of the tech names that haven't done so well as a stock recently, but, or even Disney's another example we talk about all the time. Like, Disney's down about 60 or 70% from its highs, actually even a little more than that from its highs, not that long ago. Well, if we think about that, has Disney as a business, is Disneyland 60 or 70% less occupied? Is the Disney Channel being 60 or 70%, less utilized? In fact, it's the reverse. Disney Plus has exploded, which is a giant new business for them. So, the market instead has been focused on, there was the situation in Florida. There was a situation with their CEO. Yeah, those are issues, but those aren't issues in the long term of Disney that, they're going to get the CEO, right? My son's son is still going to be watching Mickey Mouse and Star Wars and Marvel and all those things that are driving this. They're not 60 or 70% less valuable. So it goes back to that type 2 thinking, second level thinking. Don't get caught up in the emotion of the stock prices collapsing. Step aside from that and say, what does the stock represent? The stock represents ownership in Disney as a business that's been around for 100 years, has tons of intellectual property, has theme parks that are irreplaceable, has all this stuff that can't be replaced. And I think it helps you to kind of, weather those volatility storms in the underlying stock versus the company.
All right. Well, that's a good one to end on. We want to thank everyone for being here, and we want to thank Alec for presenting. This has been such an informative educational event. We really thank you for that, and also the organizations that have made this webinar possible today. For our attendees, look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar. Goodbye, everyone.
Thank you.